Good evening, everyone. Welcome to the online revision class. And today we'll be discussing about financial instruments. And the first session is for us to look at recognition, measurement, and disclosures, which means everything about the principle that relates to financial instruments, recognition, measurement, and disclosure will be discussed in the course of this class. And we are going to make use of 4 standards as a guide. IS 32, which deals with financial instrument presentation. IFRS 7, which deals with financial instrument disclosure. IFRS 9 deals with recognition measurement. And IFRS 13, which borders on fair value measurement. These 4 standards are standards we are going to harness in able to do justification to the discussion. This will be the content of our discussion, but I believe this particular topic may span to 2 or more parts, which means today we are going to introduce ourselves to financial instruments, and we'll continue from there tomorrow, which forms part 2. And depending on the pace, we'll determine whether we'll have part 3. Okay. Now, the following content are necessary for us to discuss in order to have a better understanding of the requirement of IFRS with respect to financial instruments and its accounting implications. The first one is to introduce us to what financial instrument actually is, and thereafter we'll try to classify financial instruments. We'll look at measurement of financial instruments. We'll look at the basic principles of the recognition. We'll look at derivative, trying to understand derivative rules and how it's being valued and accounted for. Furthermore, we'll talk briefly on embedded derivative and its accounting. We'll move further to discuss impairment of financial assets with respect to adopting the expected credit loss model. And we'll move further to looking at little about hedge and hedge accounting, even though at this level of financial reporting for skills under ICANN, you only have introduction to hedge accounting. The depth of hedge accounting will be discussed when we get to corporate reporting. And finally, we end it with disclosure requirements in line with IFRS 7. Okay, these are what we are going to more or less discuss as we move on. And I want us to pay more attention. It's an interesting topic. Now, when you look at what we have and we try to break it down into a simple form, what do we mean by financial instrument? The word instruments make it look like something mechanical. But when we talk about financial instrument, we are only making the word instrument to represent the form of transaction, financial transaction evidenced by certain contracts between 2 or more parties, usually 2 parties in this case. And when we look at financial instruments in a simple form or in the simplest form, we can more or less narrow it to equity, debt, derivative, and guarantees. But as we move on, have better appreciation and extension of what it actually means. Now, in line with IS 32, financial instrument is made known to be a contract that will have given rise to a financial asset of an entity and a financial liability of another entity. Okay, what it simply means is when you enter into a contract and such a contract creates financial assets in the hands of one party and simultaneously create a financial liability or an equity instrument in the hands of the other party, simply put, will call such a contract a financial instrument. Now, when you look at our presentation, you'll find out that there are two sides to the coin. Part A is entity A, Part B is entity B. Now, if a contract emanates from both parties, and at the end of the day, A will have that contract giving it rights to financial assets, and B has an obligation towards financial liability or towards equity instruments. Such is simply put as financial instrument. But better appreciation of this is when we are able to demystify each component of financial instrument, be it a financial asset, be it a financial liability, or be it an equity instrument. Now let's start with financial assets. The first level of your financial asset at any point in time is your cash. And when we talk about cash, it's not limited to physical cash. It's every form of cash, whether at hand, whether in your bank account as demand deposit, or whether in a tenor deposit, or what you call fixed deposits. All of these are considered cash. The second level of financial asset is where you as an entity invest in the equity instrument of another entity. What it simply means is this. You as a company, ABC Limited, purchase the shares, ordinary shares of another entity, which give you stake in such an entity. Such considered to be a financial asset to the investor. Or you find yourself in a situation where a contract creates a contractual right for you to receive cash or for you to receive any other form of financial assets from another entity in exchange for financial instrument with another entity under a condition that is considered favorable. And that's simply put. A critical example of such is when we look at receivables. When you enter into a contract in which you deliver goods or you render services to an entity, the goods you delivered, the services you rendered are not financial assets. But what happened is that such contracts that make you to render services, deliver goods, will necessarily create a financial asset. And imagine you sell on credit. It creates what we call a receivable. Trade receivable becomes a financial asset because you have a contractual right at the due date to collect cash or to collect any other form of financial asset as a form of settlement by the buyer to you. Lastly, we can also consider a situation where a contract that will or may be settled in the company's own equity instrument. That is, the company's own shares will be delivered to the other party as a result of this contract. Such, under the condition that one is a non-derivative for which the entity is or may be obliged to receive a variable number of equity's own shares. And we're going to discuss this as we move on further. Two, it could be a derivative that will or may be settled other than by exchange of fixed amount of cash or another financial asset. Now, these are the categories of financial assets by the definition under IAS 32. But as we move on, we'll try to look at examples of such financial assets. Now, let me quickly show you some of the examples. As I said earlier, Whenever you invest in the equity of another entity, you have created a financial asset. Whenever you invest in debt securities of another entity, such as commercial papers, such as debenture, such as bonds, you have created financial assets. Whenever you sell to others or you render services and you have a receivable, such a receivable is a financial asset, or a note receivable or bills receivable. If you give loan, whether as a financial institution or as a company, to any other entity or any other party, you have created a financial asset. And lastly, is where you have a derivative asset. And we're going to discuss about derivatives extensively as we move on. Okay. Now let's briefly look at financial liability. From the perspective of the standard, a financial liability will create what we call a contractual obligation. That contractual obligation will either require you to settle in cash or to settle using any of your financial assets you have at hand and deliver such to the other. Now, in such a condition that is considered unfavorable, what does that mean? A condition potentially unfavorable means that at every point in time, even as an individual, it's easier to borrow money. It's easier to owe people. It's easier to buy on credit. But when it comes to settlement or payment, no matter how honest you are, it's not easy to part away with your cash or to part away with any other financial assets in full settlement of your obligation. And that is why the term potentially unfavorable condition is considered or adopted by the standard. Likewise, contrary to the position of financial assets, a contract that may be settled or will be settled in company's own equity, but in this case, is a non-derivative for which the entity is or may be obliged to settle in variable numbers of its own shares. Okay, under financial asset is you are entitled to receive, not to settle. But under financial liability, opposite is the case, which means you're required to deliver or settle with variable number of your own shares. Or in the case we have a derivative, and as we discussed earlier, derivative could be asset, derivative could be liability. And we are going to get to understand that as we move on in that discussion. Let's look at examples of a financial liability. The first example is trade payable. Trade payable means that you have purchased goods from someone. You have purchased assets from someone. You have enjoyed services rendered by someone, and you have such amount due to be paid at a later date. The amount outstanding to be paid at a future date is what we call payable. And if it arose from trade, we call it trade payable. It's the number one form of financial liability. When you approach a financial institution or individuals to borrow money, you equally create a financial liability. When you issue bonds, or as an entity, you issue debt security, either as a debenture, as a commercial paper, as a bond, you have created a financial liability. And either so, when you create a contract that more or less exposes you to losses arising from such a contract, derivative contract, we say you've had a financial liability because of the derivative liability. These are examples of financial liabilities. Now let's look at equity instruments. Now, equity instruments are instruments that evidence residual interest in the net assets or in the assets after deducting liabilities of an enterprise. And that's what we call an equity instrument. Now, there is a thin line to a party to recognize either a financial liability or an equity instrument. And as we move on, the line will be defined by the border, which asks a simple question. The borderline asks a simple question. What is the question? The question at every point in time to really determine whether to a party you've created a financial liability or an equity instrument is to answer this question. And what is the question? Is settlement required? If settlement is required, in all respects, it will be classified as a financial liability. But if settlement is not required, but settlement or delivery at a later date will be at the discretion of the entity, in that simple manner, we say this is an equity instrument. A practical example is this. A company has two options to raise capital. It can either raise capital by issuing ordinary shares or raise capital through debt instruments. Now, when you raise capital through shares, what you are simply doing is that once you receive the fund and you make use of the fund to generate economic activity for the company, and there you generate the bottom line in terms of profitability. Payment of dividend is at the discretion of the entity. Peradventure, the entity is not performing and people are not interested in the equity of the company. They can put it back to the company. Rather, they can look for another person who is interested in buying such equity, or because the company is not obligated to make settlement such an instance, or because it does not require settlement. On debt instruments that with or without profitability, you are bound by the contractual arrangement to always pay interest at when due, and likewise pay upon an agreed settlement date, and which means in that situation, settlement is required. Therefore, I can easily tell you that every debt security will qualify as a financial liability. But I won't be able to tell you that every share will qualify as equity instruments. And the reason being that we have different kinds of shares other than ordinary shares. And as we move on, we'll find a picture where a preference share, which is another class of shares, can either be considered as an equity instrument or considered as a financial liability, especially for those that are considered to be hybrid instruments. Okay, example as we move on of equity instrument. We talked about ordinary shares. They are usually equity instruments. I use the phrase certain preference shares, which means I'm qualifying that not necessarily all preference shares will qualify as equity instrument, but some may qualify while others may not. Equally, when you have a warrant or written call option on your own equity based on a fixed amount of cash or another financial asset, in that situation, we will call that an equity instrument. Now, if we go back, now what we are saying is this. If entity A is a surplus unit, entity B is a deficit unit, entity B needs funds to carry on business of the entity. In that situation, he has a choice to either create a financial liability by way of contract, which means he has an obligation to settle both interest and principal at an agreed date, or he has an option to raise funds via ordinary shares in order to create an equity instrument, such that the investors in that situation are equally risk bearer and residual interest owner in that entity. While those investors, which qualify as entity A, will be considered to have created financial assets as a result of such a contract. And that's what we are trying to explain with respect to financial instruments. Now, let's talk about derivative. Now, when we talk about derivative, it's a unique nature of a financial instrument Why is it unique? Because the word derivative means that this is a contract that derives its own value from other contracts or from other underlying items. Now, what do we mean? For example, if you consider from your own perspective that exchange rate will depreciate. For example, we say Naira will depreciate against dollar. The other party have this belief that Naira will appreciate against dollar, which means they are counterparties. Counterparties in the sense that they are seeing the same thing from different perspectives. One is saying Naira will depreciate. The other person is saying Naira will appreciate. And based on this exposure, they tend to manage their risk. And what kind of risk are we managing? If you are a party that will require payment in the future, and those payments will be made in dollars, therefore, the phobia you have is the possibility of Naira depreciating, so that you will need more Naira to buy the same quantity of dollar. Now, the second aspect is this. The entity might equally, or the other party might equally consider, say, I have a receipt of dollar, but I have the phobia that by the time I receive dollar converted to Naira, I might not be able to have enough Naira, or because Naira might likely appreciate above dollar. And in that situation, they are having opposing views. And on that basis, they can enter into a contract. And what does the contract say is that the contract can expose them to a situation where one party agrees to pay certain amount and the other party agrees to collect certain amount, which is considered fixed as at the time of creating such a contract. And I'm going to break it down further into the quality of derivatives. Furthermore, I'm also going to break it down into the types of derivatives. Okay, now let's look at the qualities of a derivative. The first quality of a derivative is that it's a contract that has no value of its own, but rather it tries to create value from changes in underlying. That is, like the illustration I made, by the time dollar is fluctuating against Naira, it will create value, and it will create a positive value to one party and create a negative value to the other party. That's one quality. The other quality is that at the point of entering into that contract, investment may not be required. That is, you might need no value commitment in terms of cash to enter into such contracts. Or where cash may be required, especially when it comes to option, or you have a future contract in which you need to provide margin. In such an instance, you require a little, which we call it a leverage instrument, because you might be required to pay as little as 2%, 3% of the entire value of the contract as your commitment to that contract. And one thing that's also critical there is that even though you enter the contract today, you agree the terms today. For example, both parties have agreed that regardless of what dollar will be at settlement in 2 months' time, But today we have agreed that dollar is 450. I'll buy dollar from you 450, you deliver naira of 450. I give you $1, you give me 450. Now, the question then is, the agreement of the rate today is locked in today, but it will be made use of at the end of the 2 months, which means the rate you have agreed today is not for immediate delivery, rather is for future delivery. These are features of derivative. But as we move on, we'll break it down to have a better understanding. Now, derivative can take two perspectives or two forms. We have what we call forward commitments and contingent claim. Now, forward commitment by nature ensures that both parties have an obligation to perform. That is, I have obligation to do certain things or furnish a consideration. Likewise, you also have an obligation to perform a task. Such a contract is symmetrical. Okay, you have the first counterparty, you have the second counterparty, and they are standing in the middle of the contract. And it is symmetrical in nature. And what does that mean? It means both parties have an obligation to perform their own aspect of the contract at the settlement date. The second form is what we call a contingent claim. A contingent claim is asymmetrical. Asymmetrical in the sense that it is skewed to one side of the party than the other. But people might look at it and say, how fair is it? You will see as we move on that it is fair from the perspective of if a party buys a right, what it simply means is that it pays a premium to get a special right, so that the right will allow it to enter into a contract, and it has an option to either exercise this right or not, depending on whether at settlement the condition present favors or not. But it is asymmetrical because if the party that has a right deem it fit to exercise its right, the other party is obligated to perform its own obligation or function, regardless of what the condition is. Whereas, if the condition is not favorable to the party that has the right, it can opt out. And what it means is that the other party is compelled at every point in time to do the bargaining of the first party. That's why we say it's asymmetrical. And the reason why is because somebody pays for their rights. Such a contingent claim is synonymous to insurance contract, where you approach insurance company and you buy a policy to cover your car. Now, insurance company is obligated at any point in time when the car has an accident for them to restore the car to its normal state. And it then means that the driver or the owner of the car has an option to either drive carefully over the period of the insurance cover, or somewhat drive recklessly and crashes that car. It's an option. And upon crashing that car, the insurance will still indemnify. And that is similar to what we are talking about, contingent claim. But as we move on, you find out that derivative by way of contract can be divided into 4. 3 of these constitute a forward commitment, while only 1 constitutes contingent claim. Now, let me itemize them. There's what we call a forward contract, or simply put, forwards. Now, forward contract is a simple contract that I would classify as a customized contract. It is customized because any two parties can sit down with one another and enter into such a contract. And what does the contract say? The contract is such that both parties, as of today, agree on a particular rate of exchange, whether rate of interest, whether market price of items or commodities, or whether foreign exchange rates. They enter into such a contract today with the hope that in 30 days' time, in 90 days' time, in a year's time, in 2 years' time, once the settlement period arises, they make exchange and net settle in cash. Okay, and in that situation, what it simply means is that if company A has agreed to sell dollar to company B, and company B has agreed to pay naira in exchange for that dollar, and they have locked in a rate of 450 today. Now, in the future, rate can be 480, rate can be 400, but both parties will execute that contract upon delivery date at 450. And that's what forward is trying to say. And the quality in the forward include the following. One is a customized contract, which is a contract entered by any two parties. Two is a contract that is done over the counter, or simply put, is an OTC contract. Over the counter contract are usually customized because anybody can write the contract and enter into with another party. Now, thirdly, this contract comes with what we call credit risk. Now, imagine at the settlement date, I discovered that dollar is now 600 naira. I might decide not to buy the dollar, sell the dollar to you. Why? Because I'll prefer to sell in the market at 600 rather than more or less execute the terms of that contract, which compel me to sell for you at 450. In that case, there can be default, even though there's a legal way of seeking redress. But first, there will be a default, which means the possibility of default, more or less, is inherent in a forward contract. Okay, now, but to eliminate that or credit risk, there is this contract we call the future contract. Future contract, otherwise known as futures, is more or less like a forward contract. But the uniqueness of it is that, one, it is a standardized contract. The word standardized differs from customized. Standardized means that there is a regulation that more or less guides the principles and practices of such a contract. Secondly, there is an intermediary by compulsion, which intermediates between the two counterparties. And this intermediary is considered to be an organized exchange rather than an OTC, over-the-counter trade. Such organized exchange is similar to like the Nigerian Stock Exchange or FMDQ exchange. That exchange is considered the settlement house or the clearing house. And what that exchange does is that first, it standardizes the contract and equally guarantee no defaults. But people will ask simple question. How can a clearing house guarantee no default? Now, a future contract, unlike forward contract, when forward contract was entered into, it's just a mere exchange of paper, which is the legal document. There's no commitment of fund usually at the beginning of that contract because it's symmetrical. But for a future contract, because of the guarantee against credit default, and what is the instrumentality that is adopted or mechanism that is adopted to ensure that there is no default, is that both parties entering into this contract must more or less put down what we call an initial margin. Initial margin is like a deposit, which is relatively a small percentage of the entire contract value. And what it does is that if I enter into a contract to deliver $1 million at 4.50 kobo, and you have that same contract to deliver 450 million naira in exchange for that $1 million, and we decide to go to an organized exchange to enter into that contract, even though in this kind of contract, you barely know who is your counterparty because exchange is standing between you. Similar to you buying shares. You might be buying shares from your wife unknown to you because you only buy shares through a broker. Your wife also sells through a broker, which means you might not be aware who you are buying shares from. That is a similar framework that exists in the futures market. Now, in that situation, what then happens is that since the contract by notional amount is like 450 million naira, the exchange might require both parties to deposit money. Let's say 10% of the entire value. 10% of the entire value to the person of that more or less wanted to deliver naira is 45 million. 10% of the value to person delivering $1 million is $100,000. At that point in time, they give it to the exchange. Now, what happens? As times move on, if dollar moves to 460, it means one party has gained. The party that will deliver 450 for dollar will have gained 10 because upon settlement date, the market is selling for 460, but he is buying for 450, which means he has gained 10 naira. Now, the other party has lost money because he's forced to sell at 450, whereas he can go to the market and sell at 460, but he's compelled to sell at 450, which means derivative by this nature of contract is considered a zero-sum game. The exact gain to a party is the exact loss to the other party. Okay? That's why people more or less insinuate that derivative is a form of gambling, but not necessarily gambling, but rather it is what is used primarily for risk management purposes, or what we call financial risk management purposes, and also in today's world, it is now being adopted for speculative purposes. Now, that is it. Now, as time moves on, the loss from one party will reduce its deposit, which means the 10-year differential for that $1 million has exposed the other party to certain loss. And such loss will be debited to its margin account to reduce its deposit because it starts to lose money. The one that gains, the party that gains, will have its deposit increase because of the gain that arose. Now, what this does is that it ensures that the loss by a party is being guaranteed by the deposits made by that party. But the question then is, what if the loss continue to grow so that it erodes the entire deposit? There's also a mechanism that says that it can't erode the entire deposit because there's what we call a maintenance margin. Like if you open an account in a bank, the bank will say you have minimum deposit, which means if you have 100,000 and the minimum deposit is 10,000, by the time you deplete 100,000 to 20,000, by the time you get 10,000, the bank will tell you you cannot withdraw. Similar mechanism is here, whereby when you have such a margin, let's say you have deposited 10 million naira, and your loss over time has eroded that 10 million naira up to a level where your maintenance margin, let's say, is 2 million. By the time you get to the maintenance margin of 2 million, you receive what we call a margin call. A margin call means you have to come and restore your margin account back to that 10 million, which means you have to put additional margin of 8 million to that 2 million to take you back to 10 million. And this is a process that ensures that default. All right. And that is the mechanism of futures. And that's why you find out that in a future, there's an initial investment, even though it's of insignificant amount to the entire value of the contract. Now, the third one, which forms a family within the forward commitment is a swap contract, or simply put, swaps. Now, swap is more or less like a modified version of forward contract. Why? Swap is equally a forward contract, but the difference is that it's a multiple of forward contract, or what we call a series of forward contracts. Now, the word series is that a forward contract only requires a single delivery. I want to exchange dollar with you, $1 million at 450 naira. The delivery might be 30 days. In 30 days time, it might be 90 days time, it might be in a year time. And once we execute it and settlement date arises, we settle and we move on. But imagine, let us point out this scenario. You probably have MBA program you are doing abroad, online MBA, and you are required to pay your tuition every quarter. And you are going to pay it over four consecutive quarters, which means over a year. Now, let's say the cost would cost you $20,000. Each quarter you have to pay $5,000. But you work in Nigeria, you earn naira, therefore at every point you have to gather your salary and use it to buy dollars. Now, because you have the phobia that naira may continue to depreciate, therefore you enter into a contract with another party. Probably the party you have entered contract with is your friend. Your friend has a parent abroad, and your friend collects allowances from abroad every quarter. And your friend also have a phobia that the way CBN policy is going, it will strengthen the naira, and therefore, by the time I get my dollar in future periods and I change to naira, I'll be getting lower quantity of naira. Therefore, one person is seeing positive, one person is seeing negative. Therefore, in that situation, that's with respect to naira devaluation or appreciation. Now, with respect to that, two of you, as an opposing party or party, now agree to say, okay, I have phobia that naira will depreciate. Therefore, I agree that I will lock in at 450. You have the phobia that naira will depreciate. Appreciate. Therefore, you have a phobia that by the time you get dollar and you change it to naira, you have a lower naira. Therefore, we both agree at 450. Now, the 450 we agreed is not only to cater for the first quarter. The 450 will be the fixed rate that we exchange for in first quarter, in second quarter, in third quarter, and in fourth quarter. Which then means that by the end of the first quarter, we make settlement and exchange. By the end of the second quarter, we make settlement and exchange up to the fourth quarter. That is the uniqueness of it to forward. Forward is just a single contract, while swap is a series of forward contracts. Okay, and swap also have all other features of a forward contract. What are the features? One, it's customized. Two, it's done over the counter. There's no exchange or intermediary in that case. And thirdly, it has element of credit risk in case of default by any of the parties. These are the examples of a forward commitment. But the only contract that contingent claim is what we call the option contract, or simply put, options. Now, options, the word option means that a party in this contract has an option to either exercise its right or not, like I've explained earlier. Now, when you look at option gives one party a right, while it gives the other party an obligation. And that's why I called a contingent claim in which option characterized as asymmetric, because it is skewed to one side than the other. And the reason being that one party pays a premium, or what to call an option price, in order to enter into that contract. And since the other party has collected that price or premium from it, therefore it must immediately assume the obligation to always fulfill such whenever the holders of the option exercises its rights. And that is that about option. Now, what are the qualities of an option? One, option is customized. Okay, it's similar to customization of forward contract and swap. Option is done over the counter, which means there's no organized exchange or intermediary between the two parties. And thirdly, it gives one party a right and gives the other party an obligation. And that summarizes the type of derivative. Okay, as risk management 2, derivative is written on certain underlining. As I've explained earlier, those underlining may include FX rate, may include interest rate, may include equity prices, and may include commodity prices. And derivative we are talking about here is restricted to financial derivatives, which means this derivative must be net settled in cash. This is not the derivative that requires physical delivery of commodity, but rather this requires net settlement in cash. Okay, and as we move on, we have further discussion and understanding on it, especially when we get to the valuation and fair value measurement for derivatives. Now, as we move on also, we said something about financial instruments. I would say financial instrument is a contract that creates financial asset to an entity and creates financial liability or equity instrument to another entity. What that signifies is that when we have part B or entity B, and we are to decide whether it creates a financial liability or it creates an equity instrument based on its manner or process of raising funds for its business. Now, we have said severally that there are some instruments that has the components of a financial liability and the component of an equity instrument embedded in that singular contract. Simply put, examples of such a contract are convertible securities. What are convertible securities? Primarily, convertible securities are usually debt securities, are usually securities that have a predetermined interest and principal. But there's an option embedded in such a security that allows the holder of the security to convert it upon maturity to the shares of that company instead of collecting its money back. In that case, we say such an instrument may qualify as a compound instrument. And what my word, such an instrument may qualify, which means not necessarily all convertible securities can be considered as a compound instrument. Now, what is a compound instrument? A compound instrument is a financial contract that has an element of financial liability and equity instrument embedded in it. Now, there's a condition that we need to fulfill to consider such a convertible security as a compound instrument. One of the features is that such a convertible security as at the point of entering into that contract, which means upon initial recognition or when both parties are committed to that contract or are considered party to that contract, the conversion rates, that is, the ratio to which they will convert the debt to equity, has been predetermined and is regarded to be fixed. Okay, if that is the case, such a convertible security will be considered a compound instrument. But if otherwise is the case, such will not be considered a compound instrument. Okay, now, If it's going to be, the conversion rate will be determined at the settlement date or maturity date, which means it is variable in nature rather than fixed. Therefore, such will not qualify as a compound instrument. Rather, it will be expressly classified as a financial liability. But the question then is, the one that has a fixed determined conversion rate, which has now been classified as a compound instrument, what we now require to do is that contract, we have to split it into two elements. Though it's a single contract, but that contract has two elements embedded: financial liability component and equity component. What then we require to do is that upon initial recognition, we need to split the financial liability component out so that what is residue left is the equity component. And we have to recognize that in our financial statement. Now, to do that, there's a methodology to it. And I'll take you through the methodology. Now, let's look at the methodology. I'll use an example to explain that methodology. Now, what is the methodology? The methodology is this. To split them into two, I need to first of all identify what my contract is. My contract is that I've issued a 10% convertible bond for 4 years. The value is 1 million naira, no problem. The second question that I'll ask myself is, as at the time I'm issuing this bond for 10%, there are economic and microeconomic variables and other factors that take into consideration in arriving at that 10% that has been the coupon on the bond. Now, what then happens? Similarly, there are comparable bonds or bonds of comparable entity of similar size to that entity that were equally issued at that period, which means we look for such bonds. But those bonds we are looking for are those that does not have the option to be converted into ordinary shares, which means such bond that we are going to compare it with are what we know as trade bonds or non-convertible bonds. Now, why are we looking for that? Because if two companies, ABC Limited or ABC PLC and XY PLC, are going to issue bond at the same time, let us assume the level of business risk are the same. They are of equal size. But ABC has decided to issue convertible bond so that it gives the holder of the bond an option upon maturity to convert into the shares of the company. Or B, which is XY, have decided to issue bond of certain amount to create a dilution of the holders. Therefore, the bond I'm issuing is a straight bond such that at maturity, I pay you back your principal. I'm not giving you an option to convert it into the company's shares. Therefore, that is the only distinguishing factor between the two bonds. But technically, considering that the business risk of the entity and the level of are the same, features of the bond that are, you don't expect the two bonds to be priced at the same rate. And I'll put that question to you guys. And anybody that has an answer to it should raise up as on mute for you to explain it. The question then is, if I think the network took off. Sorry. To be switching the network. Okay, so for that, the network went off at a point in time. Okay, now as I was saying that I wanted to make a decision, economic decision in this case. And what's the decision? Let us have two companies, ABC, XYZ. They are both comparable in all respects, and they've decided to issue bond at the same time for the same period. And the bond value is of the same amount. The only difference is that ABC issues a bond that requires a fixed, that requires the holders of those bonds to convert it into ordinary shares at a later date, fixed amount of ordinary shares at a later date. The other company, XYZ, only requires to make payments of the principal amount upon maturity without an option for the bondholders to convert it to shares of the company. Now, if those two companies issue bond at the same time, and you can only buy one because of the limited capital you have, which one are you going to buy, given that ABC gives a coupon of 10% and XYZ equally give a coupon of 10%? Which bond will you decide to buy and why? Who will attempt that question? Can somebody raise up hand? Okay, I'm coming. Nobody has raised up a hand. Who is willing to answer that question? Okay. That I've unmuted you. Try to unmute yourself.
Hello, sir.
Okay. Yes. Can you answer the question? Can you answer the question?
Hello, sir.
Yeah, I can hear you.
Okay, I said if the both companies are offering the same rates of interest,
Yes.
I will go with the one that has option to convert.
Why will you go for the one that has option to convert?
I'll go with the one that has option to convert because at the end of the day, one, I would have enjoyed the same interest on my investment. And two, for converting into the ordinary shares, will give me, converting into the ordinary shares will, the price of the ordinary shares would have, I want to assume would have gone up, which will be beneficial to me at the end of the day. And that is why I think that a convertible bond with option to convert has a lower interest.
Okay. Who else have a contrary or supportive view, but from different perspective? Who is raising up hand? Alabi, can drop your hand now. Who has other views or supportive view? Who has other view so that I can move on? Okay, in the absence of none, okay, I move on with my discussion. Now, as you have said, if I were to be a bondholder and this choice is mutually exclusive, such that I have to pick one, I will always go for the bond of ABC that has an option to be converted into shares. And what is the reason behind it? It's because all things being equal, a convertible bond is more valuable, at least, than a straight bond. And why is that so? If upon maturity, let's say the shares of the company is doing badly, it's an option. I won't exercise when it doesn't favor me. Therefore, I collect back my principal and I move on. I decide not to exercise the option. But what if the shares of the company is doing well, so that by the time you collect shares and decide to sell the shares or look at your value, is it far more than principal? Which is favorable to me? What would I do in that situation? I exercise my option. That's what we are talking about. It's, if you look at the person that invested in bond, you have no option. At every point in time, to get back his principal amount. Whereas the other party that at the same time, the minimum you can get back is the principal amount, but it can get more. Share price of the company might be favorable high as at the maturity date. Therefore, what do you believe XYZ need to do to ensure that people are more or less indifferent about investing either in ABC or investing in XYZ? What do you believe XYZ can do to entice people to come and buy its own bond rather than every rush to subscribe for the bond of ABC? Who wants to answer that question? Who has an idea of what can XYZ do? A company that only wants to use a straight bond and they want people to personalize the bond because there are other bonds in the market that are convertible and at the same rate. What can you do? Who will answer that question? Who's raising up hand? What can you do if you are the management of XYZ Limited? Okay, if I have asked you to unmute.
Offer better interest, higher interest.
Like how much?
If the current is 10%, we'll offer something above 10%, but also maybe considering the prevailing interest rate. So to make it more attractive, I would say maybe 12 or maybe 11%.
Okay, thank you. Let me also hear the view. Let me hear the view of Victor. Victor.
Yeah, good evening, sir. Yeah, that's what I wanted to say, you know, to make it more attractive, offer a higher interest, maybe 12 or 15% or thereabouts. And yes.
Thank you. Now, whether 12 or 15% is relative, there are other indices you look at. But what we are simply saying, the principle there is that for XYZ to have his bond being patronized, must ensure that he issues that bond at least certain percentage higher than that of a convertible bond. In that situation, people will find it difficult to skew to one side. Why? For risk takers who say, what is the probability that the company share will rise? Therefore, let me take 12% and not take 10% because 10% is lower than a guaranteed of 12%. At least this 12% is guaranteed. But somebody that is a risk taker who want to take opportunity will say, this company is a blue chip. Therefore, I will take the one with convertible features at 10% because by the time of settlement date, the share price might have risen far more than the compensation of that 2% over the years. Therefore, what will I do? I'll decide to go for the other. At that point, you have school of thought that favors XYZ and school of thoughts that favors ABC. In that situation, each issuer will be able to have his own market. And what we need, coming back to this methodology of splitting, we said the first thing that we have identified our own bond as convertible bond. Now we have identified the bond of XYZ as a straight bond. Now, what we needed about that bond is the interest rate, which we expect to be higher than our own interest rate. And that interest rate is 12%. Now, what is the third step we carry out? Our third step will require us to determine what are the contractual cash flows. That is, this bond, what are the amount of interest we are going to pay over time? And what is the principal amount we are going to make upon redemption? Once we do that, the fourth step now says that those contractual cash flow as predetermined, we should discount them using the interest rate or the coupon rate of the straight bond, which is 12%. We'll now use that 12% to discount all those cash flows to the present. Now, remember the principle of discounting. Whenever you discount to the present, what you always are than the face value because of the principle of discounting. Now, the present value you obtain from those assets represent the amount of financial liability. Now, if what you derive from that 1 million after discounting is 950,000, 950,000 represent the liability component. Now, the residual, which is different between the face value of 1 million and 950, which is the present value, represents the equity component, which is 50. Which means upon initial recognition, as you receive 1 million into your hand by debiting your bank, instead of you to credit everything to liability as convertible instrument, you only credit 950 to liability as convertible security or bond, and the 50 will be taken equity as equity component of a convertible security, which is another class of reserve. And that's what we are talking about, which means at every point in time, whenever you have a convertible security, and such convertible security has a fixed amount of conversion up at the point it was originated, such we consider a compound instrument. And given that it's a compound instrument, such will require a split into a liability component and into equity component. Now let's look at a practical example. Now, this is a practical example. We have entity A issues 2,000 convertible bond on 1st of January 2005. The bond has a 3-year term and are issued at par with a face value of 1,000 naira per bond, which means the entire value derived from that bond is 2,000 times 1,000 naira, which gives 2 million naira. Interest is payable annually in arrears at an annual interest of 6%. Each bond is convertible at the holder's discretion at any time up to maturity into 250 ordinary shares. This qualifies it as a compound instrument because as at the time the contract was entered into, the number of shares to which each bond is converted is determined. When the bonds are issued, the market interest rate for similar debt without conversion option is 9%. which means in this case, they issue it at 3% more than the one for the convertible option. Now, the question then is, upon initial recognition, how much are we going to recognize as liability and how much are we going to recognize as equity? That leads us to this solution. Now, the first thing I do is that I ask myself, what are the contractual cash flows? What are the contractual cash flows? Now, what are the cash flows? Interest. This bond is for 3 years. Year one interest, remember, is 6% of the 2 million, which means 6% of that is 120,000. Year two is the same, 6% of 2 million, and that is also 120,000. Year three is not left behind, it is still 120,000. But in year three, there are going to be two forms of cash flows. One is interest, and the other one is the repayment of the principal amount, which is how much? 2 million. Now, if you check your timeline in discounting, you have these cash flows. Year zero, year one, year two, and year three. What are the cash flows you have? You have 120,000, 120,000, and in this year you have 2 million and 1,000. Therefore, what do? We are required to discount this back to year zero once, discount this back to year zero twice, and discount this back to year zero 3 times. And that is the principle that we require, so that at the end of the day, you say you have your years, year one, year two, and year three. You have your cash flows. Let me try and put it right. Year one, two, and three. I have my cash flows. Year one is 120, year two is 120, and year three is 120. Therefore, what do? You look for your discount factor. And we said we are going to discount at 9% because that is the rate. Now, 9%, you find your discount. Let me say it is X, Y, and what? Z. What then do? You find value. Let me say your present value is 120 times X give us A, 120 times Y give us B, 2 million, 120 times Z give us what? C. What you get as answer is D. This D is our liability component. Is our liability component. Now, looking at this question now, the present value of all the cash flows, including principal, that's for the principal, is this. The 2 million discounted back in 3 years is equivalent to this at 9%. Now the 120, 3 times it will be paid in our years, discounted back at 9% is this. the sum. When we sum it together, our DEA came to okay, I'm trying to check this. That stopped working again. What could be the problem? Okay, let's just move on. Our DEA is 1,848,122. Now, that is the liability component. Once you compare the liability component and the initial face value of 2 million, the difference is the equity component, which I call the residual. Which I call the what? The residual. And that is the position of it, which then means that at the end of the day, I am to recognize as I receive the cash, I will recognize as I receive the cash, I will recognize 2 million as debit my cash and recognize, instead of recognizing the entire 2 million as liability, I only recognize 1,848,122 as liability, while the residual, the balance, I recognize it as my equity instrument. And that simply puts us in a good light. Now, I will share this practice question with you. And in 5 minutes, I want you guys, I'm dividing into groups. 2 groups. You discuss it among yourself in 5 minutes. And you use 5 minutes to discuss it. You use another 5 minutes to do it individually. And we'll come back and compare our answers. Now, I'm going to divide you guys into groups. But before then, let me share. You already have the material, but again, let me share the materials to you so that you can download it for those that have not downloaded it before. Okay, I'm dropping it. Okay, I'm coming. Okay, well, welcome back. Okay, let's attempt the question together. The question is question 4. I'm dropping the question again on the chat. Please kindly go there now to download. I'll put it there again. Please kindly go there now and download. Now let me read the question for us so that we can all participate. Fire PLC issued a convertible bond of 1 million naira on 1st of January 2017 with a maturity date of 31st December 2019, which means it's for a period of 3 years. The coupon for the convertible bond is 12%. A comparable company to Fire PLC, that is Lily PLC, equally issued a bond of similar maturity within the same period at a coupon of 15% per annum. The only distinguishing factor between the bond issued by Fire and that issued by Lily is the convertible features embedded in the bond issued by Lily. Furthermore, you are required to determine the appropriate accounting treatment concerning of this bond in the books of Fire PLC upon initial recognition on 1st of January 2017, assuming A, the bond is converted into ordinary shares of Fire PLC based on the closing market price of the company shares at a maturity, as at maturity of the bond, and B, the bond is converted based on 5 ordinary shares for 100 naira bond notes held by each bondholder at maturity. I'll put it to you guys who will try to explain the A part of the question. Who want to explain A part of the question? Can you raise up your hand? Okay, Dari, you can explain now. You can unmute yourself.
The A part of the question is that the bond should not be split. Okay. I've unmuted myself. Can you hear me now, sir? Hello, sir.
You can continue.
Okay, I said the A part of the question simply means, okay, the A part of the question simply means that the bond should not be splitted because it does not have, like you said, that for a convertible debt to be recognized as a compound instrument, it must have the conversion rate as at the beginning of the contract. So I think that for A, it should be a financial liability rather than separating between equity and liability components.
Okay, thank you. Now, let us look at it. Question 4. Fire PLC. Now, we said convertible security that have fixed conversion ratio agreed upon as at the time both parties enter into that contract will be considered a compound instrument. In the A case, we are told that, or from the information available, it seems there is no fixed agreed conversion rate, which make it variable in nature. And in that instance, we can't consider it as a compound instrument. Rather, the convertible bond since it is convertible to variable number of shares at maturity, it is considered as a financial liability. Hence, what will be our accounting entry? Debit upon receipt of cash or bank, and credit financial liability. That is what percentage bond? That's 12% convertible bond. And we are going to do that by recognizing with the sum of how much? 1 million naira. That's just the simple answer based on our understanding of the principle. Now let's look at the B. The B says the bond is converted based on 5 ordinary shares for the 100 naira bond note held by each bondholder at maturity. In this case, there's a fixed rate of exchange. Every bond of 100 naira is converted into 5 ordinary shares. In this regard, we will conclude that it is a compound instrument. Now, since the convertible bond is agreed to be converted into fixed number of shares, it is considered a compound instrument. Hence, it requires a split into the liability component and equity component. Accounting entry. You debit your cash and bank with 1 million naira. And you credit your financial liability with X. We don't know what it is. And the balance, your equity with Y. The question then is, what is X and what is Y? We'll follow the steps. Step 1. We need to determine the contractual cash flows for 3 years. Year 1 to 3, there's interest, which is 12% per annum times 1 million naira. That gives us 120,000 naira. Year 3, we have to repay principal if settlement is required in cash of how much? 1 million naira. Now, step 2, identify a comparable bond, but with no conversion feature or option, and adopt its higher coupon rates or interest rates as a discounting factor. Now, what's our discounting factor? That is, our discounting rate is 15%. Now, step 3 is obtain the present value of the cash flows. Now, based on our tables, you guys can compute the present value. Year, I have year 1 to 3 and year 3. What is my description? Interest is constant over years. How much? 120 per year for 3 years. While principal is repaid in year 3 only. What's our discount factor? At 15%. And what's our present value? Now, discount factor at 15% is simply 1 over 1.15 raised to power n, or 1.15 raised to power minus n. Now, by the time I pick my calculator and you pick yours, I can easily determine for year 3. Discount factor in year 3 is 1.15 raised to power minus 3. And that gives me that gives me 0.6575 approximately. 0.6575. Now, cumulative discount factor from year 1 to year 3 at 15% is 1 over 1 plus R. Let me convert it to what you guys can easily remember. That's 1 minus 1 plus R raised to power minus n over R. Here is 1 minus 1.15 raised to power minus 3 over 0.15. Approximately, that should give me that should give me 2.2833, all things being equal. 2.2833. I can multiply that by 120,000. That is 273,996 and 0.6575 multiplied by 1 million. That gives me 657,500. When I sum it together, that gives me 931,496. Okay, 931,496. Okay, which that means that step 4, this present value is now our liability component. Now, step 4 is for us to determine the equity component. And the equity component is the difference between the face value minus the liability components. And what is the face value? 1 million minus 931,496. What do you have left? 1 million minus 931,496. That will give me 68,504. 68,504. Therefore, I can come here and say my X and my Y. My X is 68,504. And my Y is 931,496. And that summarizes our position. Any question? Any question, you can raise up hand if you have question or clarification. And if you got the same answer, you can equally say so. Any question? Okay, that answers the question once and for all. Okay, that is the process of identifying a compound instrument and also splitting a compound instrument into the liability component and the equity components. Okay. Now let's move further on our discussion. Treasury shares. Now, treasury shares are, as we discussed on EPS, similarly, this is where we draw our conclusion from that we are next under EPS. Treasury shares are shares of a company that is purchased or repurchased by that company. And there are reasons for doing so. One of those reasons is to buy such shares and cancel it. And the essence of that is majorly when a company is overcapitalized. And instead of having idle funds, therefore they decide to buy back their shares. Okay, when treasury shares exist, such shares are deemed not to be in existence. Whether they are cancelled or not, they are deemed not to be in existence. And in that case, in the process of calling it back, you cannot recognize gain or loss on it. Why? Because it is a transaction with owners of equity. Any excess amount paid to buy it back will be charged against your equity, your share premium. And where there's no share premium, through any other relevant reserve or retained earnings. And it is. And also, take note, dividend is not paid on treasury shares because such shares are deemed not to be outstanding. Likewise, earnings per share is not computed on treasury shares because such shares are no longer in issue. And that's why when you go back to our discussion in IS 33, when we have treasury shares, we deduct it from the opening shares in order to arrive at shares in issue as a reporting date, subject to the weighted average. And that's the position in this case. Also, IS 32 will make us realize that interest, dividend, and all realized gains and losses on financial instruments are to be identified and recognized directly in profit or loss. The only exception to it is when dividend is paid or declared by an entity. Such dividend does not qualify as an expense. That's why when we discuss IS1 and also where we try to present financial statement, we identified there that dividend paid by a company is a distribution to owners of equity. And in line with the conceptual framework, it does not qualify as an expense. And in that regard, we treat it as a reduction of the amount of equity through a deduction from your retained earnings. And that is done within the statement of changes in equity. Also, we said financial instrument create financial assets and liability on the other side or equity instrument. At every point in time, you see that entities always have financial assets and equally have financial liabilities. Now, in the financial statement, we are saying that you cannot offset financial asset the company has on one side with the financial liability it has on the other side. The only time such offset can take place are when two conditions are fulfilled. One, if there's a legally enforceable right. And usually there's legally enforceable right if the nature of the asset is such that it was created solely for the settlement of the liability. But without such a regard, it will be practically impossible for you to carry out such an offset. And that's why you find out that in the financial statement of entity, they disclose or present financial assets separately under the asset section and financial liability separately under the liability section. Also, owner's transaction. Every form of transaction that affect equity directly are considered transactions with owners of equity. Such transactions might include issue costs associated with issue of shares. They don't qualify as an expense. Rather, they are used to reduce the proceeds of the shares by deducting it from the premium. Other ones are set or buying. Anytime you pay premium on such repurchase, it is share premium, which we consider to be an expense or a loss. And that is the position. And all of our the beginning of this section now are strictly with reference to IS 32 financial instruments. Now, IS 32 gives us more understanding of the present, but as we move on, which I'm going to introduce it to you today, IFRS 9. And IFRS starts on financial instruments, where we discuss about the recognition and measurement. Okay, any questions so far? You can raise up your hand. Any questions so far? Any questions so far? Nobody's raising up hand? Okay. Therefore, it will be assumed that we have fair understanding of IAS 32. Okay. Now, but I won't jump into IFRS 9 without bridging the gap between where we were before and now. Before now, we have what we call IAS 39. IAS 39 was the old standard for the recognition and measurement of financial instruments. And under IAS 39, financial asset is classified into 4 buckets, while financial liability is classified into 2 buckets. The buckets of financial assets are as follows: fair value to profit or loss and other comprehensive, fair value to profit or loss. 2, available for sale. 3, held to maturity. And 4, loans and receivables. While financial liability is classified into 2, fair value to profit or loss and amortized cost. Now, this has now been narrowed down. For financial assets, we have 3 buckets now, IFRS 9, while the 2 buckets for financial liability were still retained. Now, let me show you the new buckets. Our new bucket is as thus. Financial asset now has 3 buckets: fair value to profit or loss, fair value to other comprehensive income, and amortized cost. Amortized cost in this Zoom, the other 2 buckets under IAS 39. What are the 2 buckets? Held to maturity and also the amortized cost. Those 2 buckets we have were collapsed amortized cost. Okay, and let me show you again so that I can see it. 4 becomes 3. These 2 held to maturity and loans are payable, even under IAS 33, are measured at amortized what? Cost. And that's part of the rationale that made it to be collapsed under IFRS 9. And the second rationale is because the tainting rule that once existed under IAS 39 is no longer required. And that's why you find out that in IFRS 9, we only have 3 buckets. Okay. Now let's have discussion about these buckets. Tomorrow, we are going to have more discussion about how you classify financial assets into any of the 3 buckets. Also, we'll look at how we can classify under what condition. Similarly for financial liability. But by tomorrow, we are going to look at this flow chart as presented by IASB on how we determine what forms of financial assets will be classified as fair value to profit loss or to fair value to other comprehensive income or at amortized cost. Similarly, we do that for liability. Thereafter, we go into measurement. How do we measure them? At initial recognition and subsequent to initial recognition. We are going to look at that. Tomorrow also we'll look at principle of derecognition. Okay, recognition is bringing an asset or liability into books. Derecognition is the manner to which you take them out of the books. When does that happen? What is the effect of it? We also later move to derivative. Why we are told to measure it only at fair value, and how do you report the fair value changes? We also move to impairment of financial assets, adopting the new model, which we call expected credit loss model. Next, we will move to understanding accounting for edge for embedded derivative. Okay, the single model that is being promulgated with respect to measurement at fair value, and where the exception exists, where we have to separate the host contract from the derivative, and we have to measure them separately. We'll also see that tomorrow. Also tomorrow, we are going to look at edge accounting as a voluntary accounting. We have little discussion on it, and what is the impact for those entities that voluntarily adopt edge accounting. And also we look at little information about what we need to disclose about our financial instruments in line with IFRS 7. And finally, because we'll be making reference to fair value much more in our discussion about measurement and recognition, we'll also borrow a leave by having to discuss little on the requirement of IFRS 13, which borders on financial instruments. On that basis, if there's any other question, can we raise up our hands? Otherwise, call it a night. I've tried to unmute you guys. You can unmute yourself and make a parting shot. I will call it a day.
Hello, good evening.
Yeah, good evening, sir.
Sorry, I joined the class very late. Apology for that.
No problem.
During your discussion, you made mention of tanking rule as one of the bases for combining
The line is breaking.
Maturity and loan and receivable under IFRS 9.
Okay. What you said is tainting rule. Tainting rule.
Okay, tainting rule.
Tainting.
I want to know what tainting rule means, please.
Okay, even though it's not relevant, but I will still, it's not relevant under IFRS 9, but I will explain it. Now, what happened is this.
Okay.
For you to classify a financial instrument into held to maturity, certain conditions must be fulfilled. One is that first, it must be a security that has a contractual cash flows. Second is a security in which you have the ability and capacity to hold to maturity, which means no matter the condition, you are expected to hold this instrument to maturity so that you are only to enjoy solely by way of cash flow the interest, contractual interest, and the contractual principal, which means you cannot decide to dispose or sell off this asset during its lifetime. And the question then is, peradventure, you have cash flow needs, or the market might be nosediving and decide to curtail your losses. In that situation, when you sell such an asset, you have tainted that bucket, which means you don't have the ability to maintain this bucket. Henceforth, they cut off this bucket so that any other assets remaining in that bucket will be reclassified out to fair value to profit or loss, or because you have no ability to carry it at amortized cost under that bucket. Okay, which means in that case, IAS 39 says we have tainted that bucket, and no financial asset can remain in that bucket for that year and for the next 2 years from that year, which means tainting will affect the current year and the subsequent 2 years which means it's a rule that affects you for averagely 3 years. And that is what it is. But there are exceptions to that rule, so that you can sell without tainting it. But the conditions are clear. If you sell very close to maturity, or if what is sold is insignificant to the value of the security in that bucket, or in a third situation when there is evidence that that entity is going to be declared bankrupt. But as economic event changes, especially from the issue about the global crash, financial crisis in 2007, 2008, 2009, development and criticism has come into place that having intention to owe something to maturity does not mean when you need to avoid such losses, because of accounting rule, you decide to more or less incur such losses that erodes the value of the business. And on that basis, tainting has now been dropped. And since that is the only distinguishing factor between loans and receivable class and held to maturity class, it is now collapsed at amortized cost. That is how the story went. Any other question? Any other one? Okay. In the absence of no question, thank you and God bless you. Goodbye.